So, if you've ever thought about buying a home in the US, you've definitely come across the term conventional loan. It's kind of the default option, right? The one most people get. But what if I told you that the money for that loan doesn't really just come from your local bank? Nope. There's a huge, hidden system working behind the scenes, and today we're going to pull back the curtain on it. So let's get right into it. Where does all that cash really come from? I mean, we're talking about trillions of dollars that keep the American dream of owning a home alive. You might be signing papers in a small office, but the journey of that money starts somewhere much, much bigger. And the answer is these two, Fannie Mae and Freddie Mac. You've probably heard the names, but most people have no idea what they actually do. These two giants are basically the engines of the entire U.S. housing market. They influence everything from whether you can even get a loan to the exact interest rate you're going to pay for the next 30 years.
Now, to really get why these two companies have so much power, we have to rewind the clock a long way back. Because this whole system wasn't invented in some fancy boardroom. It was actually born out of a massive national crisis.
So, what even is a conventional loan? In the simplest terms, it's a mortgage you get from a private lender, like a bank or a credit union. It's not insured by the government. But here's the key part, the twist. For a bank to be able to sell that loan and get its money back, the loan has to follow a super strict set of rules. And guess who makes those rules? Yep, Fannie and Freddie. You really have to picture the 1930s, the Great Depression. The housing market had just completely fallen apart, banks were going under, nobody was lending money, and the idea of owning a home was just vanishing for millions of people. The government knew it had to do something pretty radical to get money flowing again.
So in 1938, the government stepped in and created Fannie Mae. The idea was actually pretty genius in its simplicity. Banks could give out home loans and then immediately turn around and sell those loans to Fannie Mae. That way, the bank got its cash right back and was ready to lend to the next person. It worked so well that decades later, in 1970, Freddie Mac was created just to add some competition into the mix.
And if you want to know just how important they are today, well, look at this. Together, Fannie and Freddie back or own about half of all the home loans in the entire country. Think about that for a second. Their choices don't just make ripples in the housing market, they literally create the waves.
All right, so that's the history. But what does this actually look like for you, today, when you're going through the process of buying a house? Let's follow the money. It's really just a four-step cycle that keeps the whole machine running. Step 1, you get a loan from your bank to buy that dream house. But the bank doesn't want its money tied up for 30 years, right? So, step 2, they sell your mortgage off to Fannie or Freddie. This is called the secondary mortgage market. Step 3, boom, the bank gets its money back instantly. Which brings us to step 4, they can now use that same money to give a loan to the next home buyer. It's a continuous loop.
The one word you need to know here is liquidity. That's what this is all about. Think of Fannie and Freddie as the ones who make sure the river of cash in the housing market never runs dry. Without that constant flow, banks would run out of money to lend really fast, and getting a mortgage would become way, way harder for everyone.
Okay, let's talk about the part that probably matters most to you, your wallet. How does this giant behind-the-scenes system end up deciding the exact interest rate you pay?
Well, it really boils down to three main ingredients. First, you've got the Federal Reserve, which kind of sets the overall mood for interest rates across the whole economy. Second, and this is a huge one, is the bond market, specifically the 10-year Treasury note. And finally, of course, there's you. Your personal financial health, your credit score, how much you're putting down, your other debts. That all determines how risky you look to a lender.
So with all this going on, why are these loans so popular? Well, mainly because they're flexible. If you've got solid credit, they can often have lower costs over the long haul. And here's a big one. You can usually get rid of that pesky private mortgage insurance, or PMI, once you've built up 20% equity in your home, which can save you a ton of money.
Okay, so you might be wondering, is this just for the house I'm going to live in? What about a vacation spot or maybe an investment property? Good question. Yes, you can, but the rules are a little different.
The short answer is you can absolutely use a conventional loan for your main house, a second home, or a rental property. But it's all about risk. Lenders figure you're way more likely to default on a rental property than on the roof over your own head. So for an investment, they're going to ask for more money down, a higher credit score, and you'll probably pay a slightly higher interest rate too.
All right, that was a lot of history, finance, and fine print, I know. So let's zoom out and tie it all together. I'm going to boil this entire concept down with a super simple story to make sure it all clicks. Let's break this whole thing down so simply that anyone, and I mean anyone, can get it. Okay,
Imagine you want to buy the coolest toy in the store. It costs $100. This toy is your dream house. You've been saving your allowance, and you've got $20. That's your down payment. Awesome. But you're still $80 short.
So a nice friend, we'll call him the bank, lends you the $80 you need. But here's the thing. Your friend needs that $80 back pretty soon so they can lend money to other kids who also want to buy toys. They can't just have it gone for years.
So what do? Your friend takes your I promise to pay you back note, your IOU, and sells it to a grown-up. Let's call her Fannie. Fannie gives your friend $80 in cash right now. Your friend is happy. They have their money back. And now you'll just make your payments to Fannie instead.
And that right there is the magic trick. Because your friend got their cash back immediately, they're all set to help the next kid buy a toy. This cycle is what keeps the money moving around, making it possible for tons of people to get the money they need.
And that brings us to the one thing you should remember from all of this. It's that word again, liquidity. The entire housing system in the US is built on this constant flow of money. That's what makes the 30-year fixed-rate mortgage a thing, and it's what allows millions of people to become homeowners.
So now, the next time you hear on the news that the Fed is thinking about interest rates or you see a headline about the bond market, you'll know. You'll know how that's directly connected to the price of that house for sale down your street. It's all one giant web. So my question for you is, what part of the housing market will you look at differently now?